Well, good afternoon. I would like to thank everyone for attending today's webcast on navigating volatile markets. There's obviously quite a bit going on in the world right now, and that's affecting our equity markets here in the U.S. I think the biggest goal today is to try to make some sense out of what's happening and then discuss some time-tested strategies to help you navigate the current volatility we're experiencing right now here in this country. My name is Keith Johnson, and I am a certified financial planner and senior education specialist with Benefit Financial Services Group. So let's take a look as to what might be going on right now in this country. What's happening in the markets? I'm sure you've heard the headlines. Stocks plunge in largest one-day drop over coronavirus crisis. U.S. stocks halted after falling 7%. Dow bounces nearly 1,300 points as stocks end sharply higher. Stocks boosted as Trump talks coronavirus stimulus. What's truly amazing to me is all these headlines, the doom and the gloom, and then the hope, all of these occurred within 3 days of one another. So what does that mean? That obviously means there is a lot of volatility going on in the market right now. And it seems almost impossible not to get caught up when we listen to the news outlets and what they're reporting. Now, prior to the recent volatility in the markets, we were in the midst of the longest bull run in history. As the markets climbed over the last 10 plus years, I personally feel investor risk tolerance, it didn't matter. Many of the folks I sat down with and I sit down with felt the markets were just going to continue to go up and up. And technically speaking, that's true. You can trace the New York Stock Exchange back over 200 years. And that's what the markets have done. They've gone up. In fact, in any 13-year rolling average, for example, 1970 to 1983, 1971 to 1984, and so on, in the last 200 years, the markets have never been down. With that being said, there have been significant periods of volatility, like we're seeing now. So it's really important to realize that volatility is normal. It's part of the stock market cycle when we look at historical data and figures. So while it's very important to take a long-term perspective on investing, it's equally important to take a step back and distinguish between what you cannot control and what are some of the things we can't control? The markets, the economy, for example, interest rates. We just had a reduction in interest rates. So those are events you can't control. What you can control is following a plan. How much are you saving? If you get a raise, are you putting more into your 401k? Are your investments diversified? And we'll talk quite a bit about diversification. And are you within your risk tolerance for investing in the market? Because right now it is very difficult to control your emotions with everything we hear in the headlines. And we don't want to be making decisions based solely off emotions at this point. Don't assume the future. These news outlets, they seem to constantly offer conflicting opinions about the market, the economy, the political landscape, and climate. I think one thing we can all agree upon is that every single news outlet, they're in the business of getting ratings. So in an attempt to essentially increase ratings, reports are often overstated. And that makes it difficult to not overreact and potentially make a long-term decision based on the news report of a single day. That's what we're trying to push out, to ignore. It's interesting. I just read an article. This is dated March 19th, written by Dr. Bill Lloyd. He is an elected fellow to the American College of Surgeons and also a professor at the University of California, Davis Medical Center. And he discussed the impact that news outlets can have on our equity markets, and it's pretty powerful. In the article, Dr. Lloyd talks about the impact that media has had during the SARS outbreak and how that looked somewhat different from what we're seeing right now on what these news outlets are reporting. Dr. Lloyd noted that SARS, which began in late winter of 2002 and lasted into the beginning of 2003, was a deadlier coronavirus than what we're seeing right now with COVID-19. Both viruses originated in China, but SARS, he explains, did not have the financial impact that COVID-19 has had. That's partly because during the SARS outbreak, the earlier outbreak, what else was going on in this country? America was at war with Iraq. With that being said, that's where the headlines were. SARS basically had to settle for headlines below the fold of the paper. And you know it's news that drives these markets. And that wasn't the front runner at that point. Because COVID-19 really only has the Democratic presidential campaign to compete with in regards to the current news cycle, the disease has been able to shake the markets. Interestingly, though, Lloyd noted that some financial experts wonder whether the markets, were they looking for a catalyst in regards to starting a correction? We've been talking about that for easily over a year. So were they just looking for a reason? No one really knows, but it's definitely worth considering. When we talk about time-tested strategies, it's important not to chase performance. I'm sure a lot of folks at this point are asking, should I get out of the market? Or I'm down 20, 25%, so does it make sense to just ride it out at this point? When you ask yourself that question, you're essentially asking, can I time the market? Can I jump in and out of the market when I think the market's low or high? That's a very dangerous proposition, because if you embark upon this strategy, you literally have to be right every single time. So if we look back to the year 2000, or more recently 2008, investors were definitely making decisions based on emotion, and it's hard not to when the markets are volatile. In 2008, the stock market was down over 37%. Too many investors sold out at the bottom when it was doom and gloom, and in turn end up missing out on the biggest, longest bull run in the history of the market. So a lot of those folks probably were outside of their tolerance for investing. That's why it's so important to understand your risk tolerance and then build that diversified portfolio. And talking about diversification, here is a chart stemming back to the year 2009. Each one of these shaded boxes represents a different asset class. Maybe fixed income, large company growth, cash, bonds, small growth. As you look at this chart, there is no rhyme or reason as to how these asset classes have performed year in, year out. There's no trend. So that's why it's so crucial to not put all your eggs in one basket, to build that portfolio of diversified asset classes, again, from fixed income to growth to international. Why is that so key? More than 90% of your overall returns are derived from simply diversifying your portfolio. It's not about chasing the hot stock or mutual fund from last year, because in most cases, that number one performer last year could be the worst performer this year. So again, not putting all your eggs in one basket, that's where the majority of your returns long-term are derived from. And to Mark Twain's point, October. This is one of the exceptionally dangerous months to speculate in stocks. And then the others are July, January, September, April, November, May, March, June, December, August, and February. Did we miss any? Peter Lynch has this to say: far more money has been lost by investors trying to anticipate corrections, again, trying to time the market, than has been lost in all of the corrections combined. So pretty powerful stuff. It's not about trying to time the market. It's time in the market, riding out the short-term volatility that will get you to achieve your goals and objectives. And here's the proof. This chart goes back 25 years. Had you missed only the 10 best days in the market over this 25-year period, beginning in January 1991 and ending in December of 2015, only the 10 best days, your returns would have been significantly lower than the investor who stayed invested through the volatility, the short-term volatility that is. Only 10 days. That's a pretty powerful statement. If you missed the best 50 days, your returns were essentially flat. So that's why it's so important to be within your range of risk when we talk about investing in the market. You want to go into a portfolio then when things do get choppy or volatile, you're comfortable. You don't feel the urge to make an emotional decision and sell everything at a given point. Again, investing is all about taking that long-term perspective. Here's one thing we're pretty certain of. You will experience corrections, recessions, and maybe even a bear market or two throughout your retirement. What's crucially important is to understand that these events are normal. And you need to accept what you can't control, meaning what's going on externally, the headlines, and instead focus on what you can control. How much are you investing? Is that, again, your portfolio in line with your risk tolerance? Taking that long-term perspective. And honestly, we just need to keep calm at this point. A study of 51 crises since the year 1900. During that time period, the stock market fell immediately after a given crisis, losing an average of 6.7%. Then 6 months later, on average, the market was higher than before the outbreak, up close to 9%. Most investors, and this is innate, basically, overreact to market downturns. Again, over 200 years, in any 13-year rolling average, the markets have never been down. So it's understanding yourself as an investor and how much risk you can take. Once we build that diversified portfolio, it's definitely important to stay invested. 9 times in the past 50 years, the markets have crashed. If you had invested at the peak and did nothing for 5 years, how often would you have made money? Every single time. That is assuming, however, you stayed invested and rode out that volatility in the market. You really do, again, need to understand your comfort level with risk. So right now, and this is happening as we speak, people are asking, are stocks overvalued or undervalued? And even more so, is this a good time to buy or sell? And no one has a crystal ball. No one knows for certain what will happen in the markets. This could go on for a little longer. Positive news can come out and things could turn around. No one really knows. What you should be asking is, okay, how much can I lose before I deviate from my overall plan? In other words, am I not going to achieve my retirement goal or objective? What's my downside? Again, everything comes back to how much risk are you able to take on? When we talk about diversifying your portfolio, again, remember that more than 90% of your overall returns are derived from simply diversifying. In turn, this helps you protect against the external factors that you have no control over, like the economy, like inflation, interest rates, other market scenarios that may occur. So again, more than 90% of your overall returns are derived from simply diversifying that portfolio. Another question we're getting at this point is, well, okay, I'm getting closer to retirement. How much should I have invested in the market? This is a bit of a balancing act, obviously. Yes, generally speaking, you probably want to lower your risk as you near retirement and transition into that next stage of life. For a couple reasons. One important reason is you'll have less time to recover from your losses. With that being said, you probably still need to take on some type of risk just to outpace inflation and taxes. It's important to realize that you could actually be spending more years in retirement than your working years. We're living longer lives in this country. Not outpacing inflation and taxes could actually increase your chance of running out of money. And for the baby boomers, 70% of the wealth in this country is controlled by the baby boomers. This is their number one fear, running out of money. And by having 100% in cash or CDs, you are losing your purchasing power throughout retirement. So even a conservative investor, should we have a little bit invested in the market to outpace taxes and inflation? Maybe so, but that's more of a one-on-one conversation with a fiduciary credentialed advisor that's looking out for your best interests. Those are the type of conversations you should be having. So I think by now we understand it's important to, number one, own a diversified portfolio. And number two, take a long-term perspective when it comes to investing. The third thing we haven't talked about that we control is monitoring and rebalancing or resetting your portfolio as the market experiences volatility. This is really important to ensure we always stay within our tolerance for investing. It's all about sticking with your plan and then managing that risk when you're nearing and or in retirement. One example here of the importance of rebalancing. Let's say you sign up inside of your 401 plan, 457, 403b, whatever you may be contributing to. You sign up for a portfolio based on your risk tolerance that has 70% invested in the stock market and then 30% in bonds and fixed income. So let's say at the end of year one, stocks have outperformed bonds. And in some years, bonds outperform stocks. But in this example, we are assuming stocks outperformed bonds. Now, at the end of that year one, your allocation has shifted to 80% stocks and 20% bonds. Was this originally what you signed up for? Well, no, it wasn't. Originally, you only wanted 70% in stocks. So now you may be out of your tolerance for investing at this point. And let's say in year two, this continues. Stocks do well. That 80% allocation in stocks could go to 90% and so on and so forth. And then out of nowhere, the stock markets could pull back. If they pull back for 1 year or 2 years, and now you have 90% invested in stocks, that can be detrimental to your overall plan. So it's important to go in, rebalance, or reset your allocation to be in line with your tolerance for investing. And for folks who like to do all of this on their own, maybe investing is a passion, they like to rebalance. One thing to consider to ensure you continue to rebalance, do it on your birth date or an anniversary, something you'll remember so you can go back in and manually put your allocation to how it should be. If you prefer help with investing and rebalancing, most retirement plans have an auto rebalance feature that will take the guesswork out of rebalancing your portfolio. If you're looking for more oversight of your account, and if all of your retirement assets are inside of your company's 401k, then maybe a target date fund makes sense. This is more of a set it and forget it approach. First and foremost, this would ensure you're invested in a diversified portfolio. From there, the portfolio automatically gets more conservative as you get closer to your target date for retirement. Lastly, your target date fund does automatically rebalance. However, with these types of funds, they are more of a one-size-fits-all as it relates to your personal risk tolerance for investing. If you're looking for a more personalized approach, many plans offer something called an asset allocation model platform. With this option, you're insured to be invested in a diversified portfolio that will automatically rebalance. At the same time, these portfolios do take into consideration your own personal risk tolerance for investing. So how do they do that? You simply take a few minutes to complete a risk tolerance assessment, and then you are matched to a portfolio that is suitable based on your time horizon for investing and also your score on the risk tolerance assessment. Another option, many plans offer something called a managed accounts option. This option, like the other options, provide you with a diversified portfolio. It also rebalances, takes into account your tolerance for investing, while also considering any outside retirement accounts or financial assets you have, in addition to your organization's retirement plan. In most cases, there is usually an additional fee for the ongoing oversight of your retirement savings. If this seems like the better fit for you, you can easily check with your plan administrator for any additional details. And really, the bottom line in all of this, everyone's situation is totally different. And depending on your own circumstances, investing in a target date fund could make sense, or an asset allocation model, or maybe even a managed account is the best fit for you. So in regards to everything going on right now, it's important to understand a couple things. There are facts out there, and then there are opinions. At this juncture, I think it's important to ignore the opinions and make sure you know the facts, especially as everything relates to the stock market. At the 6-month mark, after every global epidemic since 1980, the markets have always come back. For example, 6 months after the SARS outbreak, the markets were up more than 14%. A year after the outbreak, the markets continued to rebound and were up more than 26%. The same scenario happened during the swine flu and Zika outbreaks. Markets were positive after 6 months and continued to climb throughout the year. In fact, to higher levels than the SARS breakout. Hopefully, you're a little more comfortable with what's going on in the markets right now after our talk and talking about long-term investing principles. Whether or not you're completely comfortable is a different story. Most of the folks I sit down with have too much risk in their portfolio. And that really hasn't mattered over the last 10 years. Now things have changed. If you're curious about how much risk you have in your own portfolio, I invite you to visit our website at www.bfsg.com. Once the page loads, then you click on the Wealth Management section at the top. If you scroll down and then click on the Free Risk Analysis button, you'll be directed to complete a risk tolerance assessment. This assessment will take you less than 5 minutes to complete. Our team at BFSG is notified when you complete the assessment. And then once I have that information, we can recommend an asset allocation mix that's appropriate for you based on how you score. In addition, we'll also prepare a comprehensive analysis of your current investment allocation. That way, we're able to see how much risk is in your portfolio. And should you be taking that much risk on? Also, going through this exercise, we're able to stress test your current allocation. Show you 90 plus what-if scenarios. What if the stock market were to go into another bear market in 5 years? What if we have another Great Depression? So we're able to look at all these what-if scenarios to make sure you're in line with how you should be investing based on your risk tolerance score. With that being said, I'm including my contact information if you have any questions about today's presentation, or if you'd like to schedule a one-on-one consultation, basically to discuss your unique financial situation. Everyone on this call, your situation is different. I'm here as a resource for you. I can be reached at 949-955-3203, or you can send me an email at keithj@bfsg.com. I'd like to thank everyone again for listening and viewing today's webcast. And please let us know if we can be of any assistance. We're here as a resource during these very uncertain times. Thank you so much and have a great day.